A boat drifts into harbor. No crew, no name. The Coast Guard tows it. Nobody claims it. That's not a mystery of the sea, that's a ghost boat. Thousands of sailboats across American waters are walked away from every year, and the Coast Guard will not claim most of them. We have ranked 10 categories of vessels most likely to become ghosts, not because their owners are reckless, but because insurers, regulators, and the math itself make abandonment the rational choice. So why does the insurance industry quietly want it that way? Our countdown begins at number 10, right at the dock. In 10th place, liveaboard cruisers without dock liability coverage set the stage for California's ghost boat crisis. These aren't forgotten hulls washed up by a storm, they are boats with people aboard, docked in urban marinas, living quietly until the paperwork fails them. Marinas require proof of dock liability insurance, but many older liveaboards can't produce it. Either their policy lapsed, the insurer refused renewal after a missed survey, or the boat is simply too old for any carrier to touch. When a marina manager asks for updated paperwork and the owner can't comply, eviction proceedings begin. But the cost of hauling out and scrapping even a modest 30-foot boat in California can hit $14,000, money most liveaboard owners don't have. So the boat sits unpaid until it is quietly abandoned. The numbers are staggering. Statewide, California tracks between 4,000 and 5,000 abandoned or at-risk vessels, a figure that dwarfs most other states. Each one started as someone's home, but a missing insurance certificate turns a slip dispute into a public liability. The Coast Guard won't claim these boats unless there is fuel leaking or a hazard to navigation. That leaves marinas and taxpayers holding the bill, while the system quietly churns out the next derelict. This isn't negligence. It's arithmetic, where actuarial tables and insurance cutoffs are the real force behind the growing ghost fleet. Number 9. Unsurveyed boats past their mandatory survey deadlines mark a quiet inflection point in the ghost fleet crisis. Every insurer in the business, BoatUS, Geico, Lloyd's, has a hard rule. If a vessel is over 15 or 30 years old, a current marine survey is not just paperwork, it is the price of admission. Miss the deadline, and the policy does not get renewed. No survey, no insurance. That is not a bureaucratic threat, it is a statistical trigger. In 2018, 22% of boats over 30 years old were denied renewal. By 2023, that figure shot up to 38%, a market-wide spike that tracks every tightening of the underwriting vice. It takes just one missed survey, a form lost in the shuffle, and a 30-year-old hull drops off the actuarial map, uninsurable, unfinanced, and suddenly unmoored from the legal system that once protected it. Owners, now facing disposal costs that can dwarf the value of the boat, are left with a choice that is not really a choice at all. The moment the survey window closes, the vessel slips from the insurance rolls and into the gray zone, one step closer to becoming someone else's problem and eventually a line item on the public's bill. The system is not failing, it is working exactly as designed. 8th place, owner-wired and American Boat and Yacht Council. Non-compliant boats are the insurance industry's favorite fire hazard, except when it comes time to pay out. Here is how the cycle works. A 41-foot sloop, recently surveyed at a cost of $950, gets flagged for amateur electrical work. The owner, thinking he has done the right thing by upgrading his own wiring, submits the survey to BoatUS Geico. Instead of a renewal, he receives a non-renewal notice citing non-American Boat and Yacht Council wiring as a material fire risk. The insurer's policy is clear: if the electrical system does not meet American Boat and Yacht Council standards, the boat is uninsurable. No exceptions, no appeals. The survey photo showing one stray wire and a mismatched breaker becomes the death sentence. The owner is left with a vessel that cannot be covered, cannot be financed, and cannot be sold to anyone but a salvage buyer. The cost to rewire to American Boat and Yacht Council specification often exceeds the market value of the boat itself. So the hull sits, quietly depreciating, until the math makes abandonment the only rational outcome. This is not a paperwork snafu. It is a structural defect that moves a serviceable boat from the insurance rolls to the public's bill. The system does not care who did the wiring, only that it is now someone else's problem. Number 7. Osmotic blister and survey carve-out hulls are where the insurance industry's quiet triage turns clinical. These are the fiberglass boats, built before 1995 mostly, whose hulls have begun to rot from the inside out. Osmotic blistering is not just cosmetic, it is a chemical breakdown where water seeps through the gel coat and reacts with the resin, forming pockets of acid that eat the hull alive. Marine surveyors know the drill. They tap the hull, map the blisters, and write up a report that reads like a medical examiner's file. One phrase, structural pathology consistent with advanced osmotic blistering, is all it takes. Insurers see that line and issue a carve-out, no hull coverage, or worse, a flat-out decline. Lloyd's syndicates, in particular, require a full classification society survey for any pre-1995 build. If the owner can't produce it, the application dies on the desk. The numbers are stark. By 2023, nearly 40% of boats over 30 years old failed to secure renewal, and most of those failures trace back to survey findings like these. The cost to peel and relaminate a hull can hit 5 figures, dwarfing the resale value of the boat itself. So the vessel lingers, uninsured and unsellable, until the owner does the math and walks away. The system doesn't wait for a storm, it waits for a surveyor's hammer. The moment the hull fails inspection, the actuarial machine kicks in and the boat begins its slow drift toward abandonment. This is not a mystery or a mistake, it's structural science turned into public debt. Number 6. Ferrocement hulls and uncertified home-built boats with no hull identification number are the demolition world's worst-case scenario. These are not the quirky passion projects of eccentric sailors. They are the ultimate orphaned assets, invisible to the insurance market and radioactive to any marina with a legal department. Ferrocement, once sold as the everyman's answer to expensive fiberglass, now sits at the bottom of every removal contractor's rate sheet. When one of these monsters, 60 feet or more, washes up, the public bill averages $58,400 per vessel. That's not a typo. The absence of a hull identification number means there is no way to stick the cost to a past owner, no lien to enforce, no responsible party to chase through the courts. The paperwork dead ends, and so does the accountability. The demolition itself is a logistical nightmare. Reinforced rebar, patchwork ballast, mystery tanks, and concrete that crumbles into hazardous debris. Every extra foot adds thousands to the invoice. State agencies, locked out of the title chain, have no recourse but to pay up and haul out. The Coast Guard will not claim these boats unless they are leaking oil or blocking a channel, so the financial burden lands squarely on taxpayers. In the actuarial machine, these hulls are the purest expression of cost without ownership, a 6-figure liability born from a missing number stamped on the transom. This is not a ghost story. It is a demolition invoice with no return address. Number 5. Former Navy and former Coast Guard hulls sold through federal surplus auctions are the actuarial machine's most expensive handoff. Here is how it works. The General Services Administration lists these surplus ships, steel tugs, cutters, and patrol boats on public auction sites, stripping away federal liens with a single bill of sale. The buyer, often a shell company or absentee speculator, walks away with a clean title and zero obligation to prove insurance. There is no background check, no financial responsibility, no requirement to show the means to haul out or dispose. The result is a ghost fleet quietly swelling in the Pacific Northwest, 37 ex-agency hulls left to rot in harbors, each one a ticking time bomb for state budgets. The numbers are brutal, over $21 million in combined cleanup costs, invoices landing squarely on taxpayers after every failed title search and every shell company dissolved. The Coast Guard steps aside unless oil is leaking or a channel is blocked. The ADV Act of 2024 was supposed to close the loophole, requiring insurance before title transfer. But as of this year, GSA's compliance is voluntary, the auction platform's still running on the honor system. So, the cycle continues. Federal agencies offload hulks, states inherit the liability, and the public foots the bill. This is not a bureaucratic oversight. It is a policy pipeline, one that turns surplus into derelict and derelict into debt. The only thing missing is accountability. Number 4. Post-hurricane CTL declared sailboats are where the ghost fleet swells overnight, not by slow neglect, but by the stroke of an insurance adjuster's pen. After hurricanes like Ian, Irma, and Maria, the system does not wait for an owner to give up. Insurers, working under the Marine Insurance Act Section 79, declare a constructive total loss, CTL, the moment repair costs tip past the insured value even if the boat is still afloat. The result is a flood of hulls, each one legally written off, stripped of coverage, and dumped into the salvage pipeline. In the year after these storms, CTL declarations jumped by 23% over the 5-year average. That is not a rounding error. It is hundreds of boats, mostly 28 to 35-foot boats, suddenly orphaned. Salvage yards cannot keep up, so insurers offload the wrecks to scrap brokers, who in turn abandon the least valuable hulls when disposal costs outweigh resale. The math is brutal. It costs $14,000 to $30,000 to haul and scrap a mid-sized sailboat, but the insurer's obligation ends once the CTL payout is made and the title is signed away. There is no statutory salvage escrow, no requirement to see the hull to its grave. The Coast Guard steps in only if oil leaks or a channel gets blocked. Otherwise, these boats linger, drifting from yard to yard until the paperwork runs out and the public picks up the tab. This is not a failure of oversight, it is a supply shock, engineered by weather and codified by insurance law. The actuarial machine does not care about sentiment or salvage. It moves on percentages, and after every major storm, the ghost fleet grows by design. Number 3. Vessels over 35 feet in Florida's hurricane zones are the chronic supply line for the ghost fleet, an actuarial pipeline that never shuts off, no matter how calm the weather. Insurers see these boats as floating liabilities, not assets. The moment a hull crosses the 35-foot mark and sits in a zip code flagged for hurricane exposure, every major carrier, Progressive, BoatUS, Lloyd's, either surcharges the premium by up to 40% or drops coverage outright. Some will not even quote a policy if the boat is docked south of Tampa or east of Miami, no matter how clean the survey. The numbers are unrelenting. Across Florida, about 3,000 derelict boats are logged in active agency case files, with Monroe County, the beating heart of the Keys, spending $800,000 a year just to haul abandoned hulls off the flats and out of the mangroves. That's $800,000 year after year, not for storm debris, but for boats that simply aged out of the insurance market and slipped through the cracks in the legal chain. The statutory abandonment window in Florida can be as short as 6 hours after a vessel is deemed derelict, but that just means the owner's name disappears from the paperwork faster. The Coast Guard will not touch these boats unless there is oil in the water or a channel is blocked. So the bills land on county desks, the hulls pile up, and the actuarial machine keeps grinding. This is not about hurricanes anymore. It's about geography, size, and a system that turns every marina in the Keys into a staging ground for the next taxpayer-funded wreck. The ghost fleet is not a mystery, it is a business model, written in insurance surcharges and paid out in public dollars. Number 2. 30-plus-year-old hulls over 40 feet are where the cost curve tilts from steep to vertical. In Washington, the Department of Natural Resources tracks more than 2,300 derelict vessels, and the scale of the problem is written in the fine print of their removal logs. These are not the battered day sailors left in a mud berth. They are the aging blue water cruisers, the 45 and 50-foot vessels that once promised freedom and now deliver nothing but invoices. The Department of Natural Resources has managed to remove 1,205 boats since 2002, but the big ones drain the budget faster than any other class. Each contract to haul out a 40-foot-plus hull runs into the tens of thousands, and that is just the start. Sediment permits, hazardous material handling, and specialized cranes stretch the average removal to 70 days and double the labor bill. For every owner who walks away, the public picks up a tab that can reach $36,000 or more. sometimes the entire annual allocation for a smaller county. The arithmetic is brutal. The bigger the boat, the more likely the insurance has lapsed. The survey is years out of date, and no carrier will touch it. Once these giants slip off the actuarial map, they become the purest expression of the ghost fleet, too large to ignore, too expensive for private salvage, and too slow to clear out without a line item in the state budget. This is not a fluke or a handful of bad actors. It is a regional pattern expanding from the Gulf to the Pacific Northwest, where every derelict over 40 feet turns into a slow-motion fiscal disaster. The system does not just allow it, it sets the stage, contract by contract, for the next taxpayer-funded wreck. And finally, in first place, the 40-plus-year-old fiberglass cruiser, think Westsail, Cape Dory, Alberg, stands as the ghost fleet's original sin. Here, the numbers do not just tell a story, they close the case. Scrapping a 40-year-old blue water hull runs anywhere from $7,000 to $45,000, depending on size and location. The legal penalty for abandonment in Florida is $5,000 to $10,000, maybe $1,500 a day in Washington, but the odds of actually paying are slim. Collection rates rarely break 40%. So the expected hit for walking away lands somewhere between $2,000 and $12,000, a fraction of what it would cost to do things by the book. The math is merciless. Owners save $10,000, $20,000, sometimes $30,000 by leaving the keys on the table and vanishing into the fog. It is not a moral failing, it is a rational calculation, sharpened by every insurer's refusal to renew on age alone. BoatUS, Geico, Lloyd's all have hard cutoffs. No survey, no coverage. Too old, too risky. The hull's value drops below the price of disposal, and the actuarial machine does the rest. States try to claw back the cost with fines, but with collection rates stuck below 40%, the public picks up the tab for most removals. The Coast Guard, bound by statute, steps in only if there is oil in the bilge or a hull blocking the channel. Otherwise, the vessel drifts, sometimes for years, until it is finally hauled out at taxpayer expense. This is not about careless owners or freak storms. It is a system engineered to offload risk, where the arithmetic of abandonment is baked into every invoice, every penalty ledger, every unpaid removal contract. The classic fiberglass cruiser is not just the most common ghost boat. It is the purest product of an actuarial machine that turns private risk into public debt. The numbers do not lie. The system works exactly as designed, and that is the real cost, measured not in lost dreams, but in line items on the public ledger. Across all 10 cases, the pattern is surgical. Old hull, rising premiums, denied coverage, a signature on a salvage form, and suddenly, it's nobody's problem but yours. This isn't random neglect, it's a machine. Insurance actuaries and legal loopholes churning aging boats into public liabilities. Ghost boats aren't mysteries. They're the inevitable byproduct of a system that privatizes profit and socializes wreckage. That's the arithmetic, cold, deliberate, and ongoing.